If your portfolio is down anything like mine is, I'm down more than $15,000, you're going to want to watch this video because I'm going to share some perspective on what I think is going on in the market, what I'm doing with my portfolio, and how I'm thinking about the future in the companies that I own. These slides are available for download at austin.substack.com. It'll be the first link down in the subscription below. As usual, we're going to share transparently. Here is the portfolio. This is total since inception. We started the portfolio on February 15th, 2020. Current value is $44,000. We have put a total of $60,000 in. And so you can see we're down about $15,600. This says we're down 56%. 15,000 divided by 60,000 is more like 28%. So that's what we're down, is 28%. Still bad, but not 56%. This is just on the day. We're down $3,700 on the day for almost 8% down. The reality is that if you invest like I do, which I'm building this portfolio up over the next 10 years, invested in growth companies, I'm gonna have this type of volatility, and I don't hedge, I don't short or anything like that. It's designed to be a portfolio that somebody that is working and contributing can build up over time. It's how I want to do it. You can find less volatility in something like value stocks or dividend stocks, or even S&P 500 index funds or something like that. Those are all perfectly good options, especially for people that don't like volatility. But for me now, as somebody that invests this way, I think this is the price of admission and the price of getting outsized, potentially life-changing returns in the future, which is what I'm trying to do with a portfolio over time. And it's my own money, so we'll see what happens. But I'm going to share why I think this is the price of admission, and why, based on history, we should expect these things, and that we can still recover from this. Let's look at individual companies. These are all very valid companies and some of the best winners, as I'll show you in just a minute. Salesforce, ticker CRM, is down 47%. Microsoft, down 22%. Alphabet, down 22%. Apple, down 18%. And these are all worse now because these were as of yesterday. If you look, Salesforce really, since 2004, this is one of its worst declines since 2004. Maybe once or twice it's been worse than this. But Salesforce is way down there. Microsoft, pretty non-volatile stock over the past 6-7 years. It's having one of its worst declines since 2015 for sure, and then even one of its worst ones since 2005. But it does drop 10-20% quite often. Alphabet, down 22%. Again, remarkably stable since 2014, 2015, even back in 2012-ish. Down 22%. Apple, down 17 or 18% now. And so the question is, do we get scared out of these stocks if we own them? Do we sell now? Or do we sit and wait to buy? What do we do? And I can't give anyone else advice, but this is how I think about not being invested. Even with all these crazy drops, and even with how bad they're down right now, 47% for Salesforce off its highs, 22% for Microsoft, 22% for Alphabet, 18% for Apple. Even though they're currently down that much from their highs, if you had invested $10,000 back in 2004 into each of these stocks, your $10,000 in Salesforce would be worth $673,000 even after this current drop. Microsoft, $154,000. Alphabet, $464,000. Apple, $3.2 million. And so if you add that up, just briefly, you're talking about 3.6 million, 3.7 million, $4.3 million. You had turned $40,000 into $4.3 million if you held on to these companies through the ups and downs for 18 years, even in the midst of their current, pretty drastic drawdowns. That is why I believe in trying to own great companies or indexes if that's what somebody prefers, and not trying to time the ups and downs and worry about, especially now with them down so much, especially now selling. That's why I'm not selling. I can't tell anyone else what to do. This is the portfolio. These are the companies I own, and this is just today. But this gives you, obviously the company name on the left side, the value in the portfolio. So Snowflake's about $5,000. Position, the gain or return, and then the top number right here is the current percentage of the portfolio. The black number is the target percentage. I have it set up in M1 Finance to, as money comes in, it just auto invests to keep them near the target percentage. And so they'll go up a little bit, down a little bit, but if it's below the target average, so Datadog, for example, is 9%, when money comes in, it's going to try to get Datadog to 10%. It's not going to sell if you're over. It's just going to balance it out with new positions. If you want to try M1, I use it for my portfolio. There's a link in the comments as well. And so those are my positions: Snowflake, GitLab, The Trade Desk, CrowdStrike, Tesla, Datadog, Cloudflare, Rocket Lab, which is a new one. I wrote about that in my newsletter. Link in the description, austin.substack.com. I'll do a video about it, but I write to the newsletter first. Mercado Libre, Bill.com, Mongo Database, and Shopify. People will point out this is very tech, very SaaS heavy. I would argue that yes, those companies will trade together when things get crazy and things get volatile. But my argument or my thesis is that these companies provide core software or infrastructure or technology capabilities. In Tesla's case, vehicles. In Rocket Lab's case, the ability to ship satellites to space. Mercado Libre and Shopify are e-commerce. Bill.com is kind of the back office for small and medium-sized businesses. And then Mongo Database is obviously databases, but they all provide critical functions that enable businesses across the economy. And so in the short term, they'll trade together as tech or SaaS sells off. But in the long term, as the economy does well and as they empower other companies, each one will kind of take care of itself if the business performs, in my opinion. What I want to show now is just kind of what I think is the quality based on the historical results we've seen from my top 3 positions, and then just how low some of these forward price sales ratios have gotten. So as we can see, this right here is the earnings history from Snowflake since it's been a public company. And we can see with every quarter except one, they've beaten on earnings per share and revenue. And the only time they missed on earnings per share was their first quarter as a public company. But we see that their most recent revenue growth was 101% revenue growth year over year. That's very different than what people were looking at with .com companies that had no revenue and were just valued off page views or something like that. And the capabilities and infrastructure and data access and capabilities that Snowflake provides to their customers is absolutely critical for business now and in the future. And this right here shows what the annual revenue estimates based on analyst expectations, so 29 analysts in 2023 and 28 in 2024, shows what those revenue expectations are for the full year of 2023. So $2 billion in revenue. That brings it to a forward price sales ratio of 22, which is pretty high. But look, revenue is expected to grow by almost 50% from 2023 to 2024, which brings it to a forward price sales ratio of 14. And so all of the revenue is not just going to go away in growth after 2024 if they're growing at 50%. If they just continue to grow at 30% or 20% for an extended period of time, this price sales multiple continues to come down. And that's why I'm okay with owning expensive companies based on the multiple. And so what this does, if you've seen me use fast graphs before, this is the fast graph chart basically, and it has analyst expectations for Snowflake for this is what they produced in 2022, and then estimates or expectations for 2023, 2024, all the way through 2028. So this number is saying that analysts are expecting revenue to grow per share 60% in FY23. FY24, 54%. We kind of just showed that in that previous slide. FY25, 41%. That's all they had estimated. So I went in and I added a pretty significant drop off for 2026, 2027, and 2028 down to 25% revenue growth. We have to remember with Snowflake, their current customers are spending 70% more from one year to the next. And so it is very likely that they're able to grow revenue for 30% or faster for the next, several years through 2028. So I think I'm being relatively conservative with that 25% growth number. We'll see. But anyways, based on that growth, these show possible returns at different price to sales multiples. So right now, the price to sales multiple blended is 30.52. That's why it's sitting on this line right here. This, in the charts I've got over here, is I can estimate them out and look at the possible returns at different price sales ratios. So I went to a price sales ratio of 5, down from 30 in 2028, and we're looking at a minus 4% total return. That'd be bad if that happened, but I think that's kind of a worst case, absolute worst case scenario. We'll see. At a price sales ratio of 8, we'd be looking at a 7%, 8% almost annualized return for a 53% total return. At a price to sales ratio of 10 in 2028, we're looking at a 12% annualized return or a 91% total return. And a price sales ratio of 15 would be a 20% annualized return for 187%. This is, 6 years from now is a long time, but we just looked at those charts where true money is made in the stock market for, Salesforce, Google, Microsoft, and Apple, or whatever company. I think those are the companies that I'm looking at. And we looked at a 12 to 14 year period where that's where life-changing returns are made. So Snowflake is a company I would love to own through 2028. I would love for it to trade at a price sales ratio of 10 in 2028 and hit these numbers. But guess what? If I can extend my time horizon and hold that thing longer, maybe for another 8 years on top of that, that's how those returns go from, potentially 90% return to 200, 300, 400% by owning companies for, decades at a time, not just blindly, if they continue to operate well and execute. And we'll monitor that along the way. We'll do it right here on YouTube if it's still there. All right, we're going to get through these faster, but this is GitLab earnings history. So they've only got 2 quarters. They beat on earnings and revenue for both quarters. And then estimates out January 23 brings it down to a 15 price sales ratio, that revenue estimate. Revenue estimate for January 2024 brings it down to a price to sales ratio of 11, which is even lower than Snowflake was, if I'm not mistaken. And then same setup here. And so I'm not going to explain the whole fast graphs chart, but I'll just run through the numbers. Price sales ratio of 5, we're looking at a 21% total return, 3% annualized. Price sales ratio of 8, a 93% total return. Price sales ratio of 10, 142% total return. Price sales ratio of 15, 263%. I don't know if it's going to be in any of those. I don't know if they're going to hit those revenue numbers or not. I did estimate it, so the analyst estimates took it out to 25, growing at 36%. I took it down to 25% after that to try to be conservative. And what that does is that gives us room if we're wrong on the price sales ratio, but they do better on revenue, or we're too low on the price sales ratio and they do worse on revenue, then giving this different range gives us basically a range of possibilities that we could expect. So somewhere between a 20% annual or total return and a 260% total return. People try to tell you and give precise estimates. I have no idea. I'm going to try to own great companies that are set up to provide a good return for me if things go well, because I don't know what's going to happen in the market. I don't know what's going to happen with these companies, but I can track them and track management and earnings and their financial results and make my decisions that way, that's what I can control, and that's what I plan to do. The trade desk was the 3rd largest position, and look at this record back since 2017, every single quarter beat on earnings, beat on revenue. That's beating analyst expectations. That is the type of quality company that I want to own. Expected revenue estimates, December 2022, expecting 1.6 billion in revenue, price sales ratio of 16. December 23, 2 billion, price sales ratio of 13. That's a little bit higher than GitLab. The trade desk is actually, growing slower. As you can see, 40%, 37% expected in 2022, 27 and 23, 26 and 24, and then I brought it down to 20. So it's expected to grow more slowly, but it is trading at the same or even a bit higher potential multiple than GitLab and maybe even Snowflake into the future as well. So the reason I think that's happening is just because generally people are just more confident in companies like the trade desk that have that proven track record of success. And it comes down to the industry and competitors and their position. And it's pretty obvious that the trade desk is just a dominant demand side platform for digital advertising. And so I think that's why it's trading at a premium, is just that reliability plus the market, and people are more comfortable with it. It does have a pretty high gross margin as well. But those things change. So anyways, on to the returns. Through 2027, price sales ratio of 5, down from 19. You're looking at minus 14%. That would obviously be bad. And then we'll just skip to 10. You'd be looking at the share price of $91 a share for a 71% total return, 10% annualized. The market average is like 8% over time. So if we can beat 8%, great. But then if you get upside and it somehow trades at a price sales ratio of 15, or maybe they do better, then our upside could be up to 157% total return or 18% annualized return. And again, this is through 2027, which is a lot of time. Many people on YouTube don't talk about those types of time frames, but I want to own this thing through 2037 if we can. Thanks for watching. Really appreciate it. Would love it if you subscribe to the channel. And just a reminder, these slides are available for download, austin.substack.com. First link in the description. Hang in there. This is hard, and I'm going through it too. So hopefully this is helpful in some way. Let me know in the comments how you're dealing with this volatility.